What unfolded in the London silver market was not a market shock, it was a governance response. That distinction matters because markets and systems fail differently. Markets fail through price, systems fail through access. What appeared on screens during the London session did not resemble uncontrolled stress or organic volatility. It resembled managed restraint, a deliberate slowing of throughput inside the infrastructure layer of the market. In a functioning commodity market, stress is noisy. Prices move first, spreads widen, liquidity becomes uneven. Participants react independently, often imperfectly, but visibly. None of those signatures dominated the session in question. Instead, the defining feature was absence. Quotes disappeared without replacement. Communication channels went quiet. Withdrawal requests were not denied, but queued. Trading language gave way to compliance language. Those are not panic behaviors. They are containment behaviors. London Nast's role in the global silver system is frequently misunderstood because most observers interact with silver through price charts rather than through logistics. London is not primarily a speculative arena. It is an infrastructure hub. It is where custody, leasing, clearing, and settlement are coordinated for a large portion of the world's physical silver that underpins paper structures elsewhere. This distinction is critical. Futures exchanges discover price. London operationalizes availability. When London is functioning normally, metal flows between miners, refiners, manufacturers, ETFs, central banks, and sovereign stockpiles with relatively low friction. Contracts settle, leases roll, bars move. Under those conditions, price signals are generally sufficient because access is assumed. When London becomes quiet, the issue is not sentiment, it is access. Modern commodity systems are built on layered claims. Paper instruments assume that conversion into physical is always possible, even if it is rarely exercised. That assumption holds only as long as the system's throughput remains unconstrained. Most participants never request delivery. They trade exposure, hedge risk, or rebalance portfolios. The system functions because belief is not tested. Stress emerges when belief is tested simultaneously. When too many actors attempt to convert claims into metal at the same time, the system faces a choice. It can allow price to rise violently, signaling scarcity openly, or it can slow conversion quietly, preserving surface stability while managing internal pressure. From a system management perspective, the second option is preferable. A sharp price spike accelerates demand. It draws attention. It invites narrative contagion. Quiet delay does the opposite. It introduces ambiguity. It buys time. This is why the absence of price movement during access disruption is not reassuring. It is diagnostic. The common framing that divides silver ownership into unallocated versus allocated categories oversimplifies the reality. Unallocated silver is a credit relationship. The holder is an unsecured creditor of an institution. Allocated silver is a custodial relationship. Specific bars are identified, recorded, and stored. The legal structures differ, but both remain embedded within institutional permission systems. Ownership without immediacy is conditional ownership. Under normal conditions, this distinction appears academic. Withdrawals are processed routinely. Allocated holders request bars and receive them. The system works because throughput is sufficient. Under stress, procedures replace assumptions. Compliance reviews replace routine processing. Delays become normalized through neutral administrative language. A freeze does not declare itself as a freeze. It presents itself as a queue. This matters because the global silver market is structurally tight even under normal conditions. Above-ground inventories relative to annual consumption are limited. Mine supply is constrained by byproduct economics, since the majority of silver production depends on copper, zinc, and lead mining. Refining capacity is geographically concentrated. Transportation, conversion, and fabrication introduce additional friction. Silver's dual role amplifies this fragility. It is both a monetary asset and a critical industrial input. Unlike gold, most silver is consumed rather than stored indefinitely. Unlike base metals, silver inventories are not widely dispersed across industrial stockpiles. They are centralized, custodial, and leveraged. When industrial buyers face disruption, price sensitivity collapses. Factories do not respond to silver shortages by waiting for market normalization. They respond by bidding for immediacy or by shutting down production lines. At that point, price ceases to function as a clearing mechanism. Availability replaces it. When industrial actors are willing to pay multiples of reference prices for immediate delivery and still cannot secure supply, it signals a breakdown in coordination rather than a simple imbalance. Transactions migrate off-screen. Quotes stop being representative. Market visibility deteriorates. This is not market failure in the classical sense. It is market compartmentalization. Under compartmentalization, access becomes implicitly rationed. Large connected participants receive priority. Smaller actors experience a delay. Retail exposure becomes increasingly abstract. The paper market may continue to operate mechanically. Futures trade, ETFs rebalance, algorithms execute. But the assumption that metal can move weakens. This detachment does not require conspiracy or intent. It emerges naturally from incentive alignment. Institutions responsible for maintaining orderly markets prioritize stability over discovery during stress. Volatility threatens confidence. Confidence supports leverage. Leverage supports volume. Volume supports revenue. Stability, therefore, becomes a systemic objective. Containment precedes repricing. Containment takes the form of friction rather than prohibition. Review protocols, conditional fulfillment, slower communication. These mechanisms are legally defensible and procedurally neutral. They reduce throughput without declaring shortage. Shortages destabilize narratives. Delays manage them. This is the framework within which the London silence should be understood. The refining layer is where these pressures become non-linear. Silver does not move from mine to end user in raw form. It must be refined into specific purities, formats, and standards depending on its destination. Industrial users require consistency. ETFs require compliance with bar lists. Central banks and sovereign holders require verifiable custody. Refining is the conversion point that transforms abstract supply into usable material. That conversion point is geographically concentrated. A significant portion of the world's silver refining capacity sits in a small number of jurisdictions, with Switzerland occupying a central role. This concentration introduces efficiency under normal conditions, but fragility under stress. And when throughput is disrupted at the refining level, the system loses redundancy. Alternative pathways are limited. Lead times expand rapidly. If vault withdrawals slow while refining output is constrained, the system experiences a compound bottleneck. Metal exists, but it cannot be transformed or moved at the speed required to satisfy demand. This is where price signals begin to decouple most visibly from physical reality. Spot prices reflect marginal paper transactions, not industrial urgency. Industrial buyers do not source silver opportunistically. They procure against production schedules. Inputs arrive on a cadence measured in days, not quarters. Inventory buffers are intentionally thin to reduce working capital costs. When supply becomes uncertain, the tolerance for delay collapses. At that point, the question shifts from what is the price to who can deliver. This shift alters behavior across the system. Procurement teams escalate authorization thresholds. Contracts are renegotiated. Force majeure clauses appear. Suppliers triage clients based on strategic importance rather than price alone. These decisions are rational at the firm level, but destabilizing at the system level. The visible market responds slowly because these adjustments occur privately. Public price formation assumes continuous two-sided participation. When one side steps away, not by selling, but by refusing to quote, prices lose informational value. Liquidity does not vanish all at once. It thins selectively. Size disappears before small lots. Immediate delivery disappears before deferred delivery. This sequence matters. Most market observers look for stress through volatility. They expect spikes, gaps, and dramatic moves. But in logistics-driven shortages, volatility is often suppressed initially. The first signal is silence, the second is delay, the third is rationing. By the time price reacts openly, allocation decisions have already been made. This dynamic explains why reported reference prices can remain stable while real transactions occur at substantial premiums off-screen. Those premiums are not speculative. They are payments for certainty. Certainty is scarce when coordination breaks down. The paper-silver market continues to operate during these periods because it is structurally insulated from immediate delivery constraints. Futures contracts settle financially by default. ETFs rebalance through authorized participants. Algorithmic strategies respond to signals that assume fungibility. But fungibility is precisely what degrades under stress. When not all ounces are equal, when some bars are accessible and others are not, the abstraction underpinning paper instruments weakens. Settlement remains possible, but conversion becomes conditional. This condition does not need to be absolute to matter. Partial friction is sufficient to alter incentives. As conversion risk rises, rational actors reduce exposure to instruments that depend on conversion assumptions. This does not require panic. It requires calculation. At the same time, institutions managing the system have incentives to avoid visible disorder. A disorderly repricing undermines confidence in benchmarks, settlement mechanisms, and custodial assurances. Stability preserves participation. Participation preserves volume. This incentive alignment does not imply malfeasance. It reflects system preservation logic. The tools used to preserve order are administrative rather than coercive. Additional verification steps, extended processing times, temporary reviews. These measures are framed as prudent risk management. Individually, each is defensible. Collectively, they function as throttles. Throttles reduce throughput without changing nominal capacity. This distinction is crucial. Reports may show ample inventory. Vault statistics may appear unchanged. On paper, supply exists. In practice, supply is constrained by process. This is how modern commodity stress hides. The impact of this concealment is asymmetric. Large, well-connected actors with long-standing relationships navigate friction more effectively. Smaller participants face delays. Retail holders face abstraction. Industrial users face existential risk. This asymmetry is not accidental. It is a feature of centralized systems under strain. As stress persists, substitution attempts emerge. Manufacturers explore reducing silver content per unit. Engineers test alternative materials. These efforts take time and often degrade performance. They signal seriousness, not resolution. In parallel, geopolitical considerations begin to surface. When a material is both strategically important and supply constrained, states begin to think in terms of security rather than efficiency. Export reviews, licensing requirements, and informal controls become more common. These measures are justified domestically and destabilizing globally. Once introduced, they are rarely reversed quickly. The global silver market is particularly sensitive to this shift because it lacks depth and diversification. Concentrated refining, centralized custody, and high industrial dependency create a system that functions smoothly until it does not. At that point, adjustment is inevitable. The only question is how it manifests. Adjustment through price is visible and disruptive, but clears imbalances quickly. Adjustment through delay is quieter, but redistributes risk unevenly. Systems tend to choose the latter first. This preference explains why the most acute phase of a physical squeeze often occurs before public recognition. Investors watch charts, industry watches shipments. By the time both are aligned, the adjustment is already underway. The London silence, therefore, should not be interpreted as absence of stress. It should be interpreted as evidence of prioritization. Access was managed, flow was slowed, stability was favored over transparency. That choice carries consequences. The final layer to examine is systemic consequence. When access, rather than price, becomes the binding constraint, the structure of the market changes. Participants no longer compete primarily on valuation. They compete on position. Who is connected? Who is prioritized? Who is essential? Who can wait? This transition alters risk distribution. In price-driven markets, losses are dispersed through valuation changes. Everyone holding exposure participates in repricing. In access-driven markets, losses are concentrated. Some participants receive metal, others receive delay, others receive substitution, others receive nothing. The price may appear stable, but the economic outcomes diverge sharply. This divergence is why traditional market indicators often fail during physical constraints. Volatility measures, correlation metrics, and price-based signals assume fungibility and continuity. When those assumptions break, the indicators lag reality. The most important signal becomes behavioral rather than numerical. Watch what participants do, not what prices say. When industrial buyers stop negotiating and start securing, the system has entered a different phase. When delivery windows matter more than benchmarks, repricing is already underway, even if it has not appeared on screens. This phase is uncomfortable for financial markets because it resists abstraction. It forces confrontation with logistics, inventory, and physical limits. These are slow variables. They do not respond to liquidity injections or narrative shifts. They respond only to time and material. This is why systems under stress prioritize delay. Delay preserves optionality. It allows inventories to be allocated strategically. It allows substitutions to be explored. It allows policy responses to be coordinated. Price, once moved, cannot be recalled. From a governance perspective, delay is control. This does not mean delay can resolve the underlying imbalance. It can only manage its expression. Eventually, adjustment must occur through one or more channels: price increases, demand destruction, substitution, or policy intervention. The order and distribution of those channels determine who absorbs the cost. Historically, commodity systems with high industrial dependency favor adjustment through non-price mechanisms first. Price is treated as a last resort because it transmits stress broadly and publicly. Silver fits this pattern. Its industrial role ties it to employment, infrastructure, and strategic sectors. Abrupt repricing risks downstream disruption. Gradual constraint shifts that burden unevenly but quietly. This creates a paradox for observers. The market appears calm precisely when it is most constrained. The absence of visible stress becomes the signal. This is why silence, cues, and procedural language deserve attention. They indicate that the system has moved from optimization to preservation, from efficiency to triage. At this stage, participants should not ask whether the market is broken. That framing is imprecise. The market is functioning as designed under constraint. It is allocating scarcity through hierarchy rather than price. Hierarchy is not visible on charts. It is visible in who gets calls returned, who receives shipments, who receives explanations, who receives templates. Understanding this hierarchy clarifies why paper exposure behaves differently from physical custody. Paper instruments are optimized for liquidity and valuation. Physical systems are optimized for continuity and control. Under stress, continuity dominates. This does not invalidate paper markets. It contextualizes them. Paper markets remain useful for hedging, signaling, and financial settlement, but they cease to be authoritative on availability when conversion is constrained. Treating them as such creates false confidence. False confidence is destabilizing. The correct analytical stance during such periods is neither alarm nor dismissal. It is differentiation. Distinguish between price signals and access signals, between nominal supply and effective supply, between ownership claims and delivery capability. This distinction is uncomfortable because it resists simplicity. It demands attention to infrastructure rather than narrative, but infrastructure is where constraints manifest first. The London episode illustrates this principle clearly. Silence was not absence. It was activity redirected inward. Decisions were being made, but not broadcast. Allocation was occurring, but not priced. That is how systems behave when synchronization risk is high. Preventing synchronization buys time. Time allows systems to adjust gradually, but it also transfers risk to those without priority. This transfer is not ideological. It is structural. In every constrained system, someone waits. The broader implication is that modern commodity markets cannot be understood solely through the lens of free-floating price discovery. They are managed systems layered with governance, custody, and policy considerations. Price is one output, not the only one. When stress rises, governance asserts itself. This assertion does not announce a regime change. It operates quietly through process. Those watching only prices will miss it. Those watching access will not. This is not a forecast of collapse. It is not a call to action. It is an observation about how systems behave under constraint. Markets do not fail loudly. They narrow quietly. And narrowing is how scarcity speaks before price is allowed to respond.